Hello everyone, welcome back. This is Nikhil here, and today I want to discuss with you about the basic things which you must know before actually investing in stocks for dividends. Now, if you haven't seen the first part, I would definitely recommend watching that video before this, as that video explains what exactly dividends are. I'll attach the link to that in the description below. Now, the goal of this channel is to actually provide a basic financial knowledge to today's youth, which schools and colleges don't provide. So, if it's your very first time here in this channel and you want to learn more about investing and small tips to grow your wealth in your 20s, then start now with subscribing so you don't miss anything out. And the thing is, guys, like always, 99% of people watching this video are not going to take any action. So be among the 1% who will take action. And if you do enjoy this video, then be among the 1% to smash the like button as well. So with that said, let's get into it. Now, I'm quite sure you all know the basics that we get dividend when we invest in stocks. But if you have invested in stocks before and maybe you got dividend, you would have seen that some companies might give like 10 rupees, some companies might give like 2 rupees. So every company has a different dividend amount. So, how does a company come up with this value? Now, this is very important, so make sure you listen to this properly. Now, there are two common terms which you need to know: face value and market value. Market value is the current price of the share in the exchange. So, whatever value you're buying the share at the National Stock Exchange, that's the market price. Now, a lot of companies they will say that we are offering 100% dividend or 1000% dividend. But the question is 100% of what or 1000% of what? It's not 100% of the market value. Trust me, if that was happening, everyone would be minting money. What I mean is, let's say you buy a share of Infosys. Now, Infosys has a current market price of 785 rupees. The company decides to give dividend and it's offering dividend of 100%. It doesn't mean that it's offering 100% of the market value, that is 785, but actually of the face value. But you might not even know what's the face value of Infosys. Infosys face value is only 5 rupees. So Infosys is offering a dividend and it announces that it's offering 100% dividend. It means that for every share of Infosys you have, you get 5 rupees. Now that's why I said before that you can't become a millionaire from dividends unless you're super rich and you're investing maybe crores into a single company. So face value is the original price which the share was distributed among the promoters of the company. The promoters are basically the people who start the company. Now, let's say me and my friends we decided to start a company. Each of us we have invested 1 lakh rupees. That's a total of 4 lakh rupees. We named the company as Financial Ltd. Now, as an investor who's starting this company, you might be thinking, what am I getting? If I invest this money in a bank or mutual fund, you'll at least get an interest of 6% or 7%. So why should you invest into this company itself? Quite simple, you will get shares. You get a share certificate mentioning that you are a shareholder and you get a certain number of shares in that particular company. Now, how many shares should you be getting? That's why face value is needed. So, this face value amount is decided by the promoters of the company itself. Depending on the face value, you will get those many number of shares. Let's say all four of us we decided that the share value should be about 2 rupees. So each of us who started the company gets 50,000 shares since our initial investment was 1 lakh rupees each. Now let's say the company is quite successful after 8 years and it's publicly listed in the exchange now. And the market price is about 250 rupees per share. And now we decided to give dividends from our profits. We decide to give 100% dividend. So 100% will not be on the 250 but it will be on the 2 rupees. So basically for each share which you have, you will get 2 rupees as a dividend amount. Now from dividend yield, we get to know as per the market price of the stock, how much dividend is the company offering. For example, let's say there are two companies, Infosys and TCS. Both the companies are offering 20 rupees dividend per share. Now from this, we won't know how much dividend has been paid out and which is paying more. Now, if I tell you Infosys price about 1000 rupees and TCS is about 2000 rupees, then in that case, you know that Infosys is clearly paid out more. So dividend yield formula is dividend amount per share divided by the market share price of that particular stock into 100. If the company pays more than 1% dividend yield, ideally it is considered to be a good company. Hence, if this is high, about 1% to 3%, the company is worth buying. But if the dividend yield is very high, let's say 7%, 8%, then there can be something wrong as well. A high yield company can be a company which has run into some problems. Now, these are common dividend traps. I made few of these mistakes when I initially started investing in dividends because a company might have a very high dividend yield to attract investors, but they slash down the dividend amount as soon as more investors come in. End of the day, if the company is struggling, it will be forced to cut out its dividend because they aren't able to reinvest into their own business. So you want to stay away from such companies. You might be thinking, so what's the big deal as you still get the amount from dividend? So it's not just that your dividend amount gets slashed, but also that the markets don't like when companies which cut their dividends. So along with the dividend yield, it is quite important for you to understand the company's payout ratio. In a very simple language, a payout ratio is just comparing the amount a company is paying in form of dividend to its annual income. So its dividend payment by net income, if this number is very high, that means the company is spending quite a lot in form of dividends. And if it's more than 100%, then this definitely red flag because in this case, the company is actually paying more in dividends than the income itself. You want to stay away from such companies. As definitely since their profit isn't much, their stock prices won't go up. And also because they're paying such a huge amount or huge portion of their current income as dividend, the company will soon struggle and it won't be able to pay dividends in future. And definitely once they pay a dividend, you will see a massive drop in their share price because these are not making any profit to the company itself. So with that said, you guys, thank you for watching this video. I really appreciate it. If you did understand how to invest in dividends, then definitely do hit the like button and make sure you subscribe as well if you haven't already. I would really appreciate all the support and I'll see you all in the next video.